Hey, welcome back to a Sunday video. We're going to go over some news and a quick portfolio update. So let's get right into it. Starting off, one of my bigger holdings, Palantir, had some exciting news where their cloud service is now cleared for Impact Level 6 clearance with the US government and Department of Defense. And there's only two other companies in the entire world that have Impact Level 6 clearance, being Amazon's AWS and Microsoft's Azure. They were previously at Impact Level 5 clearance with a few other companies, but most companies in the space have Impact Level 3 or 4 clearance, like Salesforce, Snowflake, Oracle, and Google. Now, we all know Amazon and Microsoft are trillion-dollar companies that are just absolutely huge and are the major players within the cloud computing space. So why is Palantir up on Impact Level 6 clearance with them? Well, I think they've really been proving how critical their software and cloud services are to governments around the world, not only in the US, but in Ukraine during a time of war and in other European zones. And I think that it's really important to Palantir because now they can use this to leverage with other countries in Europe and show that America, one of the biggest powerful countries in the world, trusts them at the highest level of security clearance. And so that should carry a lot of weight within other Western countries. Palantir is one of my bigger holdings in my growth portfolio, and they've had a really good month with Impact Level 6 clearance, over $800 billion in the month of September in new contracts. But Palantir has really big shoes to fill. They've set really high expectations, and it's good to see them finally executing on their plans and what they've said they're going to go and do. Now, the next topic we have is CEO Jamie Dimon from JP Chase, saying that he sees a recession within the next 6 to 12 months. So let's watch this clip and see what Jamie Dimon has to say.
But you can't talk about the economy without talking about the stuff in the future. And this is serious stuff, okay? This is inflation, which obviously is changing the effect of those numbers I just told you about. It's rates going up more than people expected already, and probably a little bit more from here. It's QT, which we've never had before. So therefore, the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt, and it's the war. And these are very, very serious things, which I think are likely to push the U.S. And the world. I mean, Europe is already in a recession, and they're likely to put U.S. in some kind of recession 6 to 9 months from now.
So the CEO of JP Chase thinks we're headed into a recession within the next 6 to 9 months. And now he sees this because of unprecedented inflation numbers, rates going up more than people expected, the war in Ukraine, and quantitative tightening, which we've never seen before. Now let's see what else he has to say about this upcoming recession.
If we do see the U.S. go into recession, how severe do you expect it to be, and how long do you expect it could last?
Yeah, well, this is the thing no one ever really knows, right? You have a strong consumer going into it. Businesses are in pretty good shape, but they were amazingly resilient during COVID. Even the ones that had no government support and stuff like that. And I think governments did do a hell of a job getting the thing to recover. So we don't know. I mean, now you have to look at the range of outcomes. It can go from very mild to quite hard, and a lot will rely on what happens to this war. So I think to guess is hard. Be prepared. But the one guarantee which we've been consistent about is volatile markets. You're going to have volatile markets. You've already seen markets down quite a bit. No IPOs, very little high yield. Bridge loans being hung and stuff like that, which is pretty typical, but it's still been orderly. I think it's possible you're going to see it be disorderly sometime in not too near future.
So there we have it. He is really worried about the macroeconomic pressures on the economy, and he thinks that can cause a recession. But I think it's important to note that he leaves himself an out with the stuff he's saying. He says these things could happen, not that they would happen, and that's smart because no one really knows what will happen, and he could be completely wrong. But all he'd have to say is, well, I didn't say it was going to happen. I just said that it could. So I think it's important to take this with a grain of salt and stick to your strategy of either dollar cost averaging into ETFs or the companies you really like, and not listen too much about what CEOs think could or could not happen. This week we also saw Meta unveil their new headset and a few other products at their event on Tuesday. And I already made a more in-depth video regarding what they released and what that could mean for the stock and the company at large, but I'll give a quick recap here. They unveiled a new headset and many new games on the Meta platform. We also got a sneak preview at their new neural system, which you can use slight movements in your hands to interact with an AR headset that we didn't get to see at the event, but he ensured is coming in the future. This device may not seem like a complete package at first, but I think it is important to realize that this is only the first version within this essentially new product category. For example, the first iPhone that we got was nothing like the iPhone that we had 5 years later, or like the iPhone that we have now. So I think it's important not to judge the product on what it is right now in its final form, but rather where's the trend going and what could this look like in the future? Because if you took the first iPhone or the first PC and said that that's all it's going to be and it won't evolve, you would have totally missed the exponential growth that we saw in these technologies. So if you believe that Meta is working on a really bright future with metaverse tech, and that the trend is going in the right way, and that this is a first step going in that direction, then I think at this price, it's really a bargain. With a 10 PE ratio, around 52-week lows, this may be a great time to get in. Now, a quick update on some of my portfolio moves that I've made this week. First, in my growth portfolio, I sold out of Adobe, and this made up a small portion of my holdings, a little bit under 1% of my portfolio. Now, I intend for my positions to be long-term holds of at least a couple of years, but that doesn't mean I won't sell out of a company if I've lost conviction or the thesis has changed on why I bought the stock in the first place. Another reason you might consider selling is if there's a better, more attractive opportunity in other places or other stocks in the market. And in this case, both of those things happened. On one hand, the acquisition of Figma changed my thesis entirely. When I first purchased this company, I believed they had a sustainable competitive advantage in their creative cloud business and all of their creative software products. But after their acquisition of Figma, they're not confident that they themselves have a moat over this new up-and-coming company. Now, Adobe could outperform the market over the next couple of years, and I could be wrong. And I no longer think that they have the competitive advantage that I once thought. Now, moving on to my dividend portfolio, where I focus on dividend growth and share price appreciation as well. I decided to sell my position in Hershey's and redeploy that into companies I had more conviction in, being Microsoft and Starbucks. Hershey's is a great company, and they have a strong balance sheet with consumer staple products that people don't want to cut out of their grocery bill. Whether it's snacks or candy, they consistently bring in the revenue and pay out steady dividends. But what I'm looking for in my portfolio is more growth, as I have a longer time horizon of over 20 years. So I think that my capital is better spent in something like Microsoft or Starbucks, which are still both very mature companies, but I believe have far more growth than Hershey's at this time.